And welcome to today's show. Today, we're talking about Social Security tips, and it says right here in this handy guide, what, when, who, how, the Social Security decisions. And Dustin, what do you recommend about Social Security? It's not what a lot of people think.
Yeah, it's not. I think everybody thinks they're supposed to wait as long as they possibly can, and in some cases that is the right way to do it, but not in all cases. Not everybody should wait. I mean, there's several things that you want to look at when you're thinking about filing for Social Security. Number one, how long do people live in your family? I know this is not fun to think about, but I mean, do people live into their 90s? Or you know, have you seen a lot of people pass away in your family in their late 60s? And really, if people pass away really early in your family, there's absolutely no reason to wait. If you're waiting until you're 70 to pull and people die in their mid-60s, you may never file.
Yeah, right.
So it really will depend on each individual circumstance on whether we'll recommend to put it off or go ahead and file.
And that can be whether or not you want it to go to your spouse or split it with your spouse while you're getting, there are all these options.
Yeah, and that's why we have the guide that we're making available to any of the viewers here today. There's over 500 different ways that you can draw your Social Security. So unless you get educated by reading the guide or take it a step further to get a full analysis done, nobody has a crystal ball. We can't just make guesses at this. We can give you some good guidance, but really getting the analysis done is the best way to answer these types of questions. If you just want to follow some generic advice, like Dustin was just saying, there's different variables that play into this decision. I, for one, usually will recommend that clients take Social Security as early as they possibly can, once they're not working anymore, because there's some limitations if you take it early. But if you've stopped working or retired or sold the business, whatever it is, go ahead and start drawing it early. Even though it may be at a reduced benefit, you're going to enjoy that money many more years than you would if you waited, and you're going to be more active and more likely to be able to enjoy the funds that you're drawing. So yeah, there's a lot of arguments out there that are saying if you wait till your full retirement age or even waiting to 70, you get about an 8% bump up each year. And that may be true, but once individuals get into their 80s and 90s, the fact that they're getting a little extra income really doesn't matter. They're not as active anymore.
I think I read somewhere it takes till you're like 82 just to get back to even.
Yeah,
so
a lot of times depends on the situation. But
Well, I'm hearing both of you say take it early in a lot of cases. So a lot of people out there, let's go take the Social Security. But there are times, I'm sure, when people should wait.
Absolutely. I mean, do you need it? If you're going to retire and you don't need it, then put it off, because if you don't need it, let it grow a little bit more. But there's not any one blanket statement that we would ever make to anyone. It's going to be each individual situation is going to require something a little different.
Yeah, the flip side of what Dustin just said, sometimes individuals they don't need the extra income, so why draw the extra income and have to pay taxes on it and things like that. The flip side of that is some individuals are maybe a little behind on their retirement planning or had to start over due to a divorce or health issue or whatever happens to individuals during the course of their life. So if you're well behind your retirement planning, then those individuals should delay as long as they possibly can, because it's going to be a significant source of their income, and it's going to be an income that they cannot outlive. And it's really interesting when we run analysis for individuals in the office, when we delay retirement, say just 1 year, so someone really wants to retire at 64 and the analysis says they should really retire at 65, that 1 year delay can really impact you positively 2 or 3 years because of how compounding interest works. Obviously, if you delay retirement 1 year, well, you're working 1 year longer, you're accumulating money 1 year longer, and really the way it works out, you need the additional funds 2 years shorter based upon life expectancy. So it makes a really big benefit for you to delay even just 1 year or 2 years or things of that nature. But those are some pretty extreme ends, those that don't need the money or those that this is all they're ever going to have. For the majority of our viewers that are kind of in the middle, most of the time it makes sense to take it earlier. But resources like the guide that we've created and the analysis we can do in the office can help answer those questions better.
And Social Security isn't something that you could start and stop. Once you start it, you're going?
Well, as long as you do it in the first year, there's a rule. I believe it's called no harm, no foul. As long as you pay back every dime they paid
but you gotta pay it back.
Yeah, so you've got 12 months to restart it basically. But after that, no, there's no stopping.
Yeah, and that question's going back to what I just said earlier. There's over 500 different ways to draw it. So there's different things that you can do, and sometimes it makes sense. someone would only do that if, their life really changed, maybe death of a spouse or maybe a major inheritance or, those types of things. But most of the time when individuals start to draw it, that's the path that they're going to stay on. Another question that we sometimes get, and I think we talk about it in the guide a little bit, is some individuals are concerned, well, is Social Security even going to be there
Right.
for us in the future? We've all heard how we have the unfunded liabilities of trillions of dollars, and I don't know exactly what Washington is thinking all of the time and what Congress is doing, but everything that we ever read or see or hear, anytime anybody even proposes making changes to Social Security, pretty much everybody age 50, sometimes age 55 or older, are completely protected to where there's little to no changes that will be made there. Younger generations, kind of what we do when we work with a client's child or grandchild, we'll kind of talk about Social Security as kind of gravy. If it's
Might
there,
be there,
Yeah.
might not.
if it's there, great. If it's not,
Yeah.
we're not counting on it. But I really think anybody watching right now, age 50, age 55 plus, already drawing it, you're not going to have to worry about it. Whatever happens in Congress, they're not going to come and take this away from individuals. Taxes may have to go higher. Younger generations might not be able to draw it, but it's going to be there. You're going to be able to count on it.
So all your questions about Social Security, when you should draw it, it's right here. What, when, who, how, the Social Security decision. If you would like a copy, you can just go to swdgroup.com and stay tuned for more Strategic Wealth with Matt Dicken after the break.
And today we actually have more mutual funds than individual stocks to pick from. So
WHAS 11 salutes Strategic Wealth Designers as a leading retirement and wealth management firm in Kentuckiana. The advisors at Strategic Wealth Designers have been helping retirees and pre-retirees live a safe and stress-free retirement since 2002.
today let's discuss a new report that we have on mutual funds, the good, the bad, and the fine print. We're happy to provide this report to anybody that requests it by contacting us at the office or going to our website and requesting the report. And if you have any money at all invested in mutual funds, I really recommend that you pick the report up. It's an easy read. It's definitely not War and Peace. We kept it as simple as we possibly could, but it's going to give you a lot of great information. To start out, it's going to explain really what a mutual fund is. You know, some people don't even really understand what a mutual fund is, but a mutual fund is just simply a collection of stocks and or bonds. And the reason why they were created was because years ago we had just individual stocks to pick from, and a lot of individual investors or beginning investors didn't know which stocks to go out and buy, so mutual funds were created where they said, okay, well just give us your money, we'll hire professional money managers to pick and choose the different stocks and bonds that we think are going to be good, and therefore we'll make it easy for you. You won't have to watch the stock market every single day. Well, if you fast forward to today, there's now about $10 billion, with a B, $10 billion spent per year on advertising by the mutual fund industry. And today we actually have more mutual funds than individual stocks to pick from. So it hasn't necessarily helped out that much, but you have a lot of different fund companies that are out there now competing for your dollars, and that's why they're spending so much on advertising. They want to get your assets under management with them so they can collect their fees and expenses. A couple things that our report talks about that a lot of individuals are not aware of, and that is the fact that some companies will have both what's referred to as quotas that they put on their financial advisors, as well as shelf space payments that they receive from mutual fund companies. So what I'm talking about here is a lot of times individuals will have some different mutual funds. Maybe it's all in one fund family, or maybe it's spread out amongst 2 or 3 or 4 or 5 different fund families, and they really don't have any idea as to why they own the particular mutual funds that they have. Well, if you work with an advisor at one of the big firms possibly around town, they may have in the past had some quotas, meaning that either their supervisors or managers or their firm required them to sell so much of a particular fund family and put it into each of their clients' accounts or portfolios, really whether or not that was the best fund or best fund family for those particular clients. The advisors literally are required or have to, if they want to remain employed with those firms, in order to stay there, they have to sell so much of these funds, sometimes on a weekly, certainly on a monthly basis. One of the reasons why the firms will impose quotas on these advisors is because some firms will receive what's called shelf space payments. Now, what this is, think about going to the grocery store. A lot of people know this already, but not everybody. The items that are basically at eye level, the brands that you see as you walk down an aisle, the items that are at eye level, those firms have actually paid a fee to be there. The firms that are kind of at the bottom or up at the top where you can't reach them, they maybe haven't paid any shelf space fee, or they haven't paid as much maybe as the name brands that are right there at eye level. So when you have a financial firm that's receiving these types of payments, it will create an atmosphere or an environment where those advisors that are working with their clients are then therefore forced or required to sell so much of those funds to their clients. And that's a little bit of information. We go into more detail in the report on that, but it's a real big issue that we see in the industry. And of course, at our firm, Strategic Wealth Designers, we've never received any type of shelf space fees, nor do any of our advisors have any quotas. The report goes on to talk about what fees and expenses to ask about or to look out for if you have money invested in a mutual fund. When you add all the different fees and expenses together, it's not uncommon to see individuals paying somewhere between maybe 1% and 3% per year on their mutual funds on average. Obviously, depending on how much money you have invested in mutual funds, over time that's going to add up to be tens of thousands, if not hundreds of thousands of dollars over, say, a 10 or 20 or a 30-year period. So you want to make sure that the fees that you're paying are reasonable, and you want to make sure that you're not paying any unreasonable fees. And again, the report goes into a little bit of information on that. And then the last item I always like to point out about mutual funds is really when they're appropriate, when they're not appropriate. And what we mean by that is mutual funds definitely have a time and a place. A great time to use mutual funds, if you want to use mutual funds, is in what's referred to as an actively funded account, which means it's any account that you're putting money into on a monthly basis. So maybe your employer plan, whether it's a 401k or a 403b, or if you have some sort of outside investment that yourself or your spouse you're contributing money to on a monthly basis, those are considered active accounts, because what happens there, as the stock market gets volatile, you don't get excited when the market's volatile. You don't necessarily like it, but you're actually taking advantage of that volatility because you're still putting money into that plan on a monthly basis. So when the stock market goes down, you're still buying more shares at a lower price. That helps you recover more quickly when the market goes up. So in an actively funded account, mutual funds can be okay. Where you definitely want to avoid using mutual funds is in what's referred to as a dormant account. Now, a dormant account is any account that you are not adding money to on a monthly basis. So it could be a previous employer's retirement plan that you never rolled over, or maybe you did roll it over, but you're no longer putting any additional contributions into it. Those accounts are considered dormant, and that's where you want to avoid mutual funds, because in a dormant account, you're not taking advantage of the volatility of the market. When the stock market goes down in value, you just lose money. You have to then sit around and wait and hope for it to go back up in value, and that's an environment that you want to avoid using mutual funds in. So if you have mutual funds or you have additional questions about mutual funds, feel free to contact us and request the report, Mutual Funds, the Good, the Bad, and the Fine Print. We'd be happy to send you a copy.
At 90% of the time, it's going to underperform the benchmark that it was designed to beat. Hi, and welcome back. We're going to spend a little bit of time talking about the differences between ETFs and mutual funds and whether or not one is better than the other. And Matt, you want to talk about the differences between the two?
Yeah, so let's first talk a little bit about some of the similarities.
Okay.
This is probably a great place to start, because I think a lot of people are sometimes really confused what these are. Mm-hmm. So obviously with a mutual fund, it's a collection of stocks or bonds. Mm-hmm. That has a fund manager that's basically running the fund or managing the fund. So he or she is buying and selling different stocks and bonds, mm-hmm. hopefully making moves that will make the value of the account go up.
Right.
The reason why mutual funds were created was originally when the stock market got started, mm-hmm. As more and more companies came on board, individual investors just didn't know what stocks were the right ones to buy.
Right.
You know, it wasn't what they were doing for their living or focusing on every single day. So mutual funds were created. Mm-hmm. Basically what they said was, hey, we'll hire some professionals, give us your money to manage, and we'll buy the right stocks or bonds along the way, so we'll make it easy.
Right.
Well, you fast forward to today, and there's actually more mutual funds than there are stocks to invest in. So I don't know how much easier it is. But over time, as mutual funds have gotten more and more popular, some of their problems or issues have also been uncovered, and that's why ETFs were created.
Right.
To kind of give a little bit of an improvement on the whole mutual fund concept. So ETFs are also known as exchange-traded funds, are also a collection of maybe stocks or bonds, but they're very different in that they're not traded or managed, I should
Right.
say, where you don't have a fund manager that you're paying to buy or sell different stocks or bonds. It's basically you just buy into an index, and there's an index for basically everything you can think of, and then they'll make adjustments maybe once or twice a year, but they're not in there making daily adjustments.
You know, on that note, when it comes to mutual funds, you mentioned the word index, and it made me think all mutual funds are measured on how good or how bad that they are by an outside benchmark, and it's usually the S&P 500 index.
Usually, yep.
Notice I said index.
Yeah.
Now, if you invest money into a mutual fund, I think I read 90% of the time, it's going to underperform the benchmark that it was designed to beat.
That it's trying to be, yeah.
So why not go invest directly into that benchmark?
Well, that's a good question. And I think that's kind of why exchange-traded funds have been created.
Yeah.
Because the fund managers, historically, they have not been beating the indexes that they're trying to beat. So any fund manager in a given year might look like a superstar.
Right.
Right? They might have amazing performance, but it's hard to consistently outpace the indexes.
Yeah.
Another issue that comes up that the mutual fund industry doesn't necessarily notify you when it happens, but let's say that I'm a rising star as a fund manager, and I work for some small mutual fund most people have never heard of, but I had amazing performance. Well, usually what will happen is one of the bigger firms will come along, one of the bigger boys will come along and recruit me away
Right.
to go work for their mutual funds. And so the reason why that fund performed so well has left the building.
Yeah.
But
Literally.
but they don't tell you.
Yeah.
They don't notify you of that. So that's some we're starting to get in now into some of the issues
Yeah.
with mutual funds that investing in exchange-traded funds kind of solves. It kind of fixes the issue or the problem.
So with that, when they're recruited away, when you're looking at maybe the different funds that you have as an option to choose from, and say a 401k, and you look at the last 1 year and the last 3 years and the last 10 years,
Yeah.
and they've averaged 4% or 12%, does that mean that the guy that accomplished that, a guy or girl that accomplished that, may not even be there?
They may not, and again, they won't tell you that on their glossy
Right.
brochures
Yeah.
and things like that. It's another thing you have to watch out for in looking at their star ratings,
Yeah.
like Morningstar ratings. I think it was something like 95% of the technology funds, as rated by Morningstar prior to the dot-com bust, were 5-star mutual funds.
Oh, wow.
So the day before they lost 40 or 50 or 60% in value, they were the top performing funds up until that point. So you have to understand that what they're analyzing when they get those stars is what's happened in the past. And obviously doesn't guarantee what will happen moving forward. But some other issues with mutual funds where I think they're at a disadvantage to exchange traded funds are their fee structure. They're much more costly on an annual basis. They're as far as fees go, but also the way that they're treated from a tax standpoint.
Oh, yeah.
Much more inefficient than an exchange traded fund, and then they're not openly traded.
Yeah.
All day long. Meaning, a mutual fund, if you put in an order to buy or sell a mutual fund, all those orders get filled at 4 p.m. So whatever happens that day, you're kind of stuck with whatever that price is when the market closes. Whereas an exchange traded fund is it's an openly traded position. So if it looks like the economy is going to have some struggles or maybe some good things came out and you want to buy in at a lower price, you can do those types of things with an ETF that you cannot do with a mutual fund.
So a situation, somebody's 5 years away from retirement and they have a portfolio of all mutual funds. They're wanting to be a little conservative, and then they hear that something happens in Asia, and they call their advisor and say, hey, get me out of the market today. Are they stuck then until?
Well, they're stuck till 4 p.m.
Okay.
So even if they try and call in early first thing in the morning, the trade doesn't get executed until 4 p.m. So that's why a lot of advisors that rely on mutual funds will tell you things like, well, just ride it out. It'll bounce back. You're in it for the long run. You'll be fine. It always recovers. Just a paper loss. They start saying all these ridiculous things.
Yeah.
Because they can't do anything. I mean,
It's
by the time that they liquidate it, it's probably already dropped 3 or 4 or 5% in value that day. So ETFs, I think, in the future will overtake mutual funds.
Yeah.
As far as popularity goes, we watch the flow of money, and there's actually some months there's more money flowing into ETFs than are actually flowing into mutual funds. Now, mutual funds have been around a lot longer.
Yeah.
So they've got quite a bit of a head start, but so right now there's still more money invested in mutual funds, but eventually that'll change.
Yeah.
Just because they're better from a management standpoint. ETFs are better than mutual funds from a fee standpoint, certainly a tax standpoint, and you also you know what you own inside of the ETF. Mutual funds, you can get a list of the stocks or the bonds that they hold today, but they change almost every single day. Right? So you might like what they're invested in today, but nothing says that you're going to like what they have 3 months from now. Whereas the ETF, it only gets adjusted slightly, maybe once or twice a year. So you can look at that and know exactly what you're buying into, and nobody's going to change it on you.
What about overlap? I hear this term, overlap of positions. You may own 5 or 7 or 8 different mutual funds, and when you look inside of the mutual fund itself, they all own Apple, they all own Amazon.
Kind of invest in the same thing. Yeah, that's another good point, where it's difficult to know if you have true diversification. And that kind of goes back to what I just said, in that when you own a mutual fund, you don't always know exactly what it's invested in.
Yeah.
Whereas the exchange-traded fund, you can prevent overlap because you know exactly what the positions are.
Can you use stop losses on mutual funds as well as?
On a mutual fund, you cannot. So again, a stop loss is if you have a tolerance for how much you're comfortable with losing.
Yeah.
Maybe 5% or 10% on a position, 3%, whatever the number is. If it drops that much in a period of time, it'll automatically get sold and the money will be moved to cash, and that can help prevent a massive loss. You can't use stop losses on mutual funds. You can on exchange-traded funds because, again, they're traded openly throughout the day.
Right.
But mutual funds, you're just stuck with whatever the price is at 4 p.m.
Okay. So if you're currently using ETFs in your portfolio, that's great. But if you have questions about whether or not it's appropriate for you or whether or not it should maybe be replacing your mutual funds at this point, give us a call at our office and we can talk about it. And the 90s were, I know a lot of you are thinking, were probably some of the best years that the stock market has ever had. Well, if you're thinking that, you're right.
Look, nobody's born knowing how to plan for retirement. So why not start your retirement education the same way thousands of Kentuckiana couples have? By attending one of our educational seminars created and hosted by financial professionals at Strategic Wealth Designers. The retirement professionals at SWD will show you ways to make informed decisions. For many, this workshop was the first stop on the road to their successful retirement. Register for an event that works best for you at swdgroup.com/events.
Hi, welcome back. I want to spend some time talking about something called a safe withdrawal rate. And basically what the safe withdrawal rate is how much money that you're allowed to take out of your accounts hopefully without running out of money. There was a study done years ago, back in I believe around 2000 by AARP, that said that 4% was the amount of money that you could take out of your accounts, and statistically you shouldn't run out of money during your lifetime. Well, if we think about that, back in the year 2000, we had just made it through the 90s. And the 90s were, I know a lot of you are thinking, were probably some of the best years that the stock market has ever had. Well, if you're thinking that, you're right. The stock market in those years was averaging around 14% per year. As a matter of fact, even bonds back then were averaging around 6% per year. Well, back in 2000, that study was put out, I believe it was, that said 4% is how much you could take out of your accounts. So if you have $1 million portfolio, that would mean that you could pull out about $40,000 per year out of that account. And statistically speaking, you have about a 90% success rate. So you shouldn't run out of money if you're doing that. Now, this study was done on a 60-40 split, which means you're using 60% stocks, maybe 40% bonds. Well, let's fast forward to today. Is the stock market still averaging 14%? I wish it was. The stock market now is averaging right around 8%. So pretty different than a 14% per year average. And bonds today are averaging around 3%. So about half of what they were back in 2000. Well, would you think that we could still take 4% out of that account per year? Probably not. As a matter of fact, Wall Street Journal put out a study, it's been a few months back, maybe a year ago now, that said that a safe withdrawal rate at this point is around 2 to 3%.
So think about that. If you have $1 million portfolio, let's say you've worked your entire year, you've put money away every single month from your paycheck, and now you've accumulated this nice nest egg. You've got maybe $1 million saved up. Well, you're going to move into retirement, and what that study tells us is we could take somewhere between $20,000 and $30,000 a year out of that account. That's probably not going to excite a whole lot of you, and it shouldn't. It wouldn't really excite me either. There's still ways that you can achieve a 4 to 5, maybe even 6% withdrawal rate, but it's not using that old 60-40 split that maybe your mom and dad used to, or maybe when I'm speaking, it was my grandparents that used that. Today, investment strategies, tools, objectives are very, very different than they were back in 2000. So your investments must evolve with the times. You could still try that stock and bond strategy, and it may work. But statistically speaking, 2 to 3% is all you could really take out of that account and not run yourself out of money. So we talk a lot at our firm about something called the Rule of 100. Now, we work primarily with those that are retired or within about 10 years of retirement. So really, this is what our firm is based around, is generating income plans that our clients can pretty much bank on. They know what it's going to be for their lifetime. There's a little bit of fluctuation, but it's not going to be nearly what the stock market would be. So what that means is, what the Rule of 100 is whatever your age is, you take that from the number 100, and that would be the percentage of your assets that you want to be in a very safe and protected environment, getting guaranteed results year after year after year. Then, if you're comfortable with risk, then with the balance of that portfolio, that's where you can go out and take a little bit of risk. So let's think about that. Let's say that we have that same couple, and they've saved $1 million in their portfolio, and now they're, let's say, 65 years old. Well, that would mean 65% or $650,000 of their portfolio they would want to have in something that's safe and protected and guaranteed, getting income that's going to last as long as they need it to. Now, there's some companies out there that will even offer up to a 6% guarantee. So 6%, I mean, if you think about that on a $650,000 portfolio, that's over the 2 to 3% withdrawal on the $1 million, and you've still got $350 left. So 6% on $650,000 is $39,000 per year. Then with the balance, that other $350,000, now you can go out and play with a little bit of stock market risk and maybe use some of those 3% bonds that we were talking about a while ago, or maybe try to go after those 8% returns that the stock market is averaging. So if you're nearing retirement, if you're within 10 years or so of your retirement, and you're thinking, well, I'll just use that 60-40 rule that Mom and Dad talked about, things have changed today. It's time to reach out and talk to someone that specializes in retirement planning. Give us a call at our office, and we'd be happy to talk with you about how to structure your portfolio to transition over into your retirement years. We look forward to hearing from you.